Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of speaking with Kris Benson. Kris Benson is with Reliant Real Estate Management, a major player in self-storage space. Their company is a top 25 into commercial self-storage operators in the U.S. And Kris Benson is the Chief Investment Officer, and he is responsible for all the equity, debt, and all the financial sides of the transactions within their business. Their company has completed over $650 million worth of self-storage acquisitions and dispositions within the last 5 years. They recently completed a fund called Reliant Self-Storage Fund I, a $50 million equity fund that was addressed for this self-storage acquisitions. And Kris is a central player within their investment committee, and a lot of knowledge, a lot of due diligence goes through his desk, and it's a tremendous pleasure to welcome him. And I'm looking forward to this conversation. Thank you for taking time, Kris, today. I appreciate it.
Yeah, my pleasure. Thanks for having me, Sakar. I hope your introduction was too kind. I hope I live up to it.
Good, awesome. And as we spoke before, Kris, that we have worked in the past, on different investment opportunities and things like that. So your company, your name is a household familiar name for sure. For listeners, help us with a background, Kris, as to, how you came about into the industry and with Reliant in general.
Yeah. So my background's a little bit unique in that I came from a corporate sales environment. The last corporate job I held was with Intuitive Surgical, the manufacturers of the Da Vinci robot. And what got me into real estate is probably not too dissimilar than what a lot of people have experienced, where you're trying to create some facet of passive income.
Sure.
And so I distinctly remember, I've told this story before, but I distinctly remember waking up just before I turned 30 and said, I can't do this for another 30 years. Like this is not what I'm going to do. I was in a fantastic company. I'm making pretty good money and enjoying myself, but my work-life balance was rough. So I'm a big believer that you got to enjoy the journey as much as the destination. And if you're not enjoying the journey, you got to do something different. So, from my perspective, I started, I think not too dissimilar than you did. I started buying some duplexes in my local market, and very quickly realized that was not scalable for me. I hated it. I hated it almost more than work. Primarily what I didn't like is the people aspect of it. It just seemed like we were always dealing with people issues, as opposed to, we had worked out kind of the real estate issues, management, plumbing, electrician, fixing toilets, that kind of stuff. But the people issues just beat me up. So with that, we ended up selling that portfolio, and I heard it's a podcast or a book, or I read it somewhere, basically that big deals and small deals are the same amount of work. You just make less money on small deals. And so I said, let's see if we can scale into multifamily. And so my first commercial multifamily project was a 64 unit apartment ground up complex that I did with a partner who was a construction guy, owned a construction company. And I went to church with his family growing up. I hadn't talked to him in probably 15 years, and called him one day and said, hey, I want to get into commercial real estate. I'd like to build some apartments. What do you got? And that led to a pretty big discussion, and a long story short, that was kind of my foray into commercial real estate. And
Interesting.
when I saw that, Sakar, that's kind of when the light bulbs went off. I said, this is how you can build this at scale, not deal with people on a daily basis, and create some true wealth and income. So that's what got me started. And we did some commercial multifamily, did some passive investing in commercial multifamily around the country, and then about I guess it's 3.5, 4 years ago now, as cap rates have compressed in multifamily, I started looking at other asset classes, and that's what brought me to self-storage. First as a passive investor, I was an investor at Reliant first, and then came in as the CIO, as you mentioned in the intro, about 2 years ago, and then helping build the equity raising platform they have. So I know that was a lot of talking all at once, but that's generally how I got to where I am.
Interesting that you realized regarding scale long time ago. Was that your partner in the 64 units, Kris, who introduced you to this concept of syndications and partnerships that you can come in and do it? How did that come about?
That's a great story as well. The answer is no. It had nothing to do with my construction partner. I'll give him a quick shout out. The name of the company is Buck Construction. He's in central New York. But what ended up happening is a childhood friend who lived in South Boston at the time, and it must have been 10 years ago now. But in any event, he got laid off from his job. He was in the financial services industry and got laid off. And I said, "What are you going to do?" And he said, "I think I'm going to flip these row houses in Boston." And I said, "How are you going to do that?" And he said, "Well, first I got to raise $900,000. And I was like, "How? How are you going to do that?" And he introduced me to the idea of syndication. I didn't even understand that it exists. I mean, I knew inherently there were JV partnerships to be had,
sure,
but certainly didn't understand the idea of what a syndication was, and how that platform works. So that was the introduction where I kind of said, I get it now. Like, that's how we're going to be able to do something at scale with this.
Sure. And for lack of a better term, it's almost a partnership of sorts, right? Where, you have the passive investor sides who are investing. So there's some technicalities to syndications, but at a very sort of a basic conceptual level, it's pretty much a partnership between just the passive investors and the active, investors or sponsors, as we call it, right? So now, Kris, moving on to the Reliant, or perhaps the self-storage aspect of it, right? Why did you maybe hone in on self-storage? Like you initially indicated that, yes, you had some experience about, let's say, the developing your 64 unit. And I think it sounds like you tried purchasing multifamily apartments as well. How did that shift come about?
As I mentioned, like, what I saw in the market was cap rates compressing. And so as that got more and more competitive, I wanted to see if there were other asset classes where, there was more of a runway, I guess. I'm a believer that everything's cyclical, right? So capital is going to find yield. And so, if it can't find it in multifamily, it's going to move to industrial. If it can't find it in industrial, we're going to go to mobile home parks or whatever the case may be. And so, I think for me, I'm a data guy, and I just started chugging through some data. First, looking at historical returns. That's kind of how I started. I like the National Association of REIT data because it gives you a good broad-based view on all asset classes and their subspecialties. So you can, if there was a REIT for it, timber, agriculture, you can see the publicly traded data on that. And the data set's 20 plus years old, so you can see some pretty good historical trends. Storage in the last 25 years did just under 17% a year, which is amazing.
Absolutely.
It outperformed the major four, right? Apartments, retail, office, industrial. And so when I saw that, I thought, well, that's really interesting. And, the second piece of it, data I looked at was, well, what happened in the last recession, right? So I'm also a believer that almost everything is going to happen again. Maybe not this pandemic, although I guess if we look back to 1918, we would have seen this thing coming. But, looking back at the 2007, 8, and 9 Great Recession, the data there suggested that self-storage performed very well. It lost less than 4% of its value. And even compared to apartments, that number was closer to 7. Retail, office, double digits. Obviously, the S&P 500 was down more than 20% over those 3-year periods. So, you have this asset class that, one, performed very well historically, and then in the last downturn also did well. And just fast forwarding a little bit, Sakar, we're seeing that same trend today. We're recording this in the middle of June.
Sure.
So we're still seeing how, COVID-19 is going to affect us. But, what I would say is, so far, the asset class has fared pretty well. So, the third reason that I really fell in love with storage was that the market is very fragmented. So
right.
You have 5 publicly traded REITs that your listeners probably all know.
Sure.
The Public Storage, Extra Space, Life Storage, those companies. They own about 25% of the market, and then the rest is spread all over the board. There's
sure.
a significant number of mom and pop operators.
Right.
People own 1 or 2 facilities, and so with that, there's a consolidation play. A roll-up strategy to be had. For your listeners who maybe come from a private equity background, the ability to take the sum of the whole is worth much more than the sum of the individual parts.
Sure.
So, it was really those 3 reasons: the historical performance, how it did in the last recession, and the upside, the runway for it, that I think brought me to the asset class.
Interesting. Thank you. I mean, that actually clarifies a lot and probably answers some of my follow-up questions as well. Now, Kris, you mentioned that there's a historical sort of background to this. I mean, you see the runway and things like that, right? Now, coming to the nitty-gritty of the business itself, right? You mentioned the sort of the whole self-storage market in general is pretty fragmented, right? So how do you identify the opportunities? Like what sort of goes into your the research side of things to kind of start delving into a market and looking at some of these opportunities?
Well, I mean, I don't think we look at probably the same metrics that all real estate investors do as far as looking at a particular market, right? So the same things that might be important for a multifamily investor: population growth, job growth, income, average income. Those kinds of things certainly matter at the macro scale.
Sure.
What's interesting about self-storage is that what really matters is the 1, 3, and 5 mile radius around your facility.
Sure.
Because think about it, it's a car, right? You're not going to travel for self-storage. We're selling a garage, right? I mean,
right.
An air-conditioned or heated garage. And so, it's got to be either convenient to home or work.
Sure.
And if it's not, there's not an amenity. We don't have granite countertops in our self-storage facility that you're going to go rent. So,
sure.
Really it's about that 1, 3, and 5 mile radius and truly understanding the comps in that market, specifically the supply side, what other facilities are there and who your competitive set is. And then also understanding the dynamics in that 1, 3, and 5 mile radius, because you can be in a radius, but not in traffic flow, right?
Interesting.
Traffic count is a big part of what we do. And if people aren't driving by your site, then they're not going to rent there. Right. So that's, I think, some of the things we look at, and our acquisitions team has really dug into the minutia of understanding the 1, 3, and 5 to the point when we get a property under contract. One of the first things we do is geomap. So we get a list of all the addresses of the tenants and then geomap where they are. So we can look at it in the 1, 3, and 5 mile ring and understand what geographical barriers, what things are influencing people to come to the site. Because it also helps you understand, from a risk of new development coming to your market, you know generally where new development's going to come. And you can see, like, okay, if a new site opens here, are we going to be impacted because all our tenants come from here? It's just about really understanding that 1, 3, and 5 mile ring.
I see. Now, A related question there, Kris. Like, let's say a 200 storage pads, a deal comes around, right? But it's
Mhm.
not on the main thoroughfare or on sort of the main street that's there. Maybe it's on one of the like 2 blocks away or on a side street or things like that, right? Uh, is there anything that you consider something like that? It sounds like you stated that the traffic counts and the main visibility is extremely important. So I assume that sort of translates into, sort of organic marketing and things like that, right? So let's say if a asset comes around that's probably a few blocks away or on a side street and things
Mhm.
like that. So does that mean that that won't be a good candidate? I mean, just curious.
Not necessarily. There's not one metric that has to be perfect. I
Hmm.
mean, certainly the supply is a big indicator,
Sure.
of what other facilities are in the market.
Hmm.
But how I like to think about our underwriting process, and we have 2 guys on the Reliant team that do all the underwriting, and we're trying to improve that model all the time.
Sure.
But how I like to think about the underwriting is it's a story, right? We try to understand the story of that particular market.
Hmm.
And so one metric may not tell that story, right?
Sure.
And you may miss opportunities if it's just, hey, I have to have 25,000 cars a day or I'm not going to look at the property.
Right.
Well, okay, some people may invest that way, but you're going to miss some opportunities for sure. So I think for us, um, it's a piece of the story,
Hmm.
but not necessarily the whole thing. So if we come across property that may not be on the major thoroughfare, but
Hmm.
there are some other advantages to where it is,
Hmm.
we'll take that into account. And Sakar, what I would say is the feet on the ground piece is the critical part of this. Understanding the market specifically.
Hmm.
I think that's a critical part to how our underwriting process works.
I see. Now, Kris, moving on, as company as large as your company is today, are you always looking to acquire a minimum number of units so that you can get some scale in a particular sort of city or a sub-market? What goes into your mind? Let's say if you were to enter into, let's say, Tennessee or Alabama today, for example, right? I'm just, throwing out there, right? But are you maybe always targeting that, okay, we want to have like 1,000 or 1,500, 2,000 units before it makes sense for your company to go out and go into a submarket or a state in general?
No, not necessarily.
Hmm.
We don't have a specific metric that creates cost efficiencies, I guess, on our management platform.
Hmm.
We're vertically integrated, so we're managing the properties that we're buying.
Hmm.
Certainly, the more properties we have in a smaller geographic area, the more efficient we can be, especially with payroll
Sure. Hmm.
in the management of those sites. But I would say that how we look at the portfolio is one, geographic proximity, and secondly, with an eye on the exit. Because if you're going to sell a portfolio of assets,
Hmm.
the group who's buying it, whether that be a REIT or institutional capital, depending on the size, is also going to want to understand that same efficiencies of scale.
Hmm. Hmm.
So, for example, we sold a 14 property portfolio in March of this year, where if you put tax on a map,
Hmm.
it makes sense, right? You would look at it and say, okay, I can manage that swath. And
Hmm.
especially for, the REITs who we've disposed many properties to, it's valuable for them to be able to say, I can plug my platform into that.
Hmm. Hmm. Interesting, interesting. Now, as we all know, Kris, that self-storage, as we all say it, right? I mean, it's a closed unit with a door. There's not much to it, right? Um,
Mm-hmm.
how do you add efficiencies, or perhaps we are all in the game of, obviously giving outsized returns to investors and things like that. So, I mean, coming from a multifamily side, where we say that, okay, you can increase the rent and decrease expenses, and there are lots of amenities and stuff like that we can all sort of improve upon. There's management efficiencies and things like that. So help us kind of understand how you sort of increase the whether the efficiency, or how do you increase the NOI in a self-storage facility?
Yeah, so our sweet spot, Sakar, has really been value add deals in secondary and tertiary markets across the southeastern United States. That's where we've had the most success. What I would say is there's no cookie cutter approach to a value add, right? You mentioned the multifamily, like we're not going in, putting in hardwood floors, stainless steel appliances, and granite countertops.
Sure.
The business plan is different in each asset that we look at. And so, I would say that we look at a particular asset and what the opportunity may be to add value. Sometimes that's expansion, right? So we're taking, a 15,000 square foot self-storage building, and we're going to add it to the back of the property, right? And maybe we're adding some climate control in a market where we think it's undersupplied. That's a way to grow NOI, right? Because you expand it, you get it leased up, and your NOI growth is growing exponentially. There are some other ways that we're doing it just from an operational standpoint as well. So things like ancillary income items, in self-storage, there are other ways to make money. Things like U-Haul truck rental, tenant insurance, admin and late fees, those types of items, which typically are 10%-ish or so of our pro forma's income, especially when we come across, mom and pop operators. There's usually some pretty good upside to be had on that. As well as sometimes with mom and pop operators, they're just operating at under market rate, right? Not too dissimilar to multifamily.
Sure.
They have a property that's been in the family for 30 years. No one's actively watching it. It's just cash flowing. And they may be 10, 20, 30% below what market rates would be. And so there's sometimes opportunities there.
I see. Now, what about some physical improvements? Like I know you stated that, yes, you can add additional usage. So that's a direct, income increase there. I can understand that. But what if you get a, as you stated, like a mom and pop operator owning for 30 years, just bare basic, running it just on a nice cash flow, laid back gentleman, right? So how you go in, like, are you adding fences, or are you doing, like new driveways, things like, give us a sense of what goes into it, like really on the ground.
Yeah, I mean, we have a project manager who's going to look at every site and understand what deferred maintenance may be there, right?
Sure.
So the things you mentioned, fences, gates, security, the painting, what our office looks like, a retail office. That's a critical component for us, making sure that when people walk in, it's light, bright, airy, feels good, smells good, those kinds of things. It's interesting. Self-storage is a business that you have the real estate play, like you do in multifamily.
Sure.
But you also have this operational business on the side, right? Where you're selling point of sale systems, locks and boxes, and you have this retail component where the person behind the desk is almost as important as the property, right?
Sure.
Because if you got somebody behind the desk who, is not welcoming, does not provide great customer service, you're going to lose tenants, right? Because ultimately we're selling a commodity. Like you mentioned, it's a box.
Sure.
So, I think for the improvements we can make, it's all over the board. Sometimes it's driveway. It's really a deferred maintenance piece that we'll look at and say, hey, what do we need to do? I think how we look at every property is with the lens of how we exit. If we're going to sell this to a REIT, what are they going to want it to look like? They may change the sign and the colors. But if we give them an asset that's generally looks and feels like an institutional quality asset, that's going to be interesting for them.
Right. Now, again, going back to those physical, aspects, Kris, there, a lot of older self-storage properties could be like extremely dilapidated. Nowadays, we are getting, whether it's like hardcore steel or like a combination of cement and iron doors and things like that. Does your company have a standard way of how you want your facilities to look like, other than just the color part of it? Can it be like just anything? Just curious.
Give me an example when you say how it looks, like positioning in the office and that type of
No, I
thing,
guess I can
or
understand the aesthetics of the office and how the interior space and all that. But let's say someone walks outside the office, and now we are actually looking at your storage units, right?
Mhm.
Do they have to be all physically cemented with iron doors, or do they have to be like corrugated steel, things
Oh, I
like that?
understand what you're saying.
Uh,
Yeah,
so, those aspects, meaning is there like a brand associated with it?
I wouldn't say like if you walk down all our facilities, I mean, they're generally the same, but some have brick facades, some have cement. It really depends on, there's not an ROI on changing the structure of the
Sure,
building
sure.
generally.
Hmm.
So what we're looking for, as far as major changes like that, is flow through the property.
Hmm.
Ensuring the drive aisles are wide enough to get a truck down, right, a moving truck, and that you can
Sure.
turn around and get back out the other side. Like
Hmm.
those kinds of things is where our operations team and our construction management team, when we look at a new property, are going in and saying, all right, this is wonky. We can't have this. So we got to, knock this wall out, take these units out, reposition them, whatever the case may be.
Hmm.
But really, Sakar, I would say, because there's such a spectrum of different types of operators,
Sure, sure.
we look at each property opportunistically.
Hmm.
I can give you an example. We bought a property in Tennessee last summer that there was a building that had enough roof height to
Hmm.
add a mezz level of storage inside the building. So the building was
Interesting.
already there. We basically are just putting another set of units on top of the units that are already there.
Sure.
So, we're trying to be opportunistic when we can take those advantages. But it really is property by property specific. We're not going into everyone and saying, here's our box. It fits right
Right.
inside that.
Right. Good. Thank you for that detail. Now,
Sure.
Kris, give us a sort of a reverse example of maybe a deal or some opportunity you may have passed on that just did not fit the sort of the metrics, whether it was the market or the deal itself, or the traffic counts and some things. Because I always like to ask our guests that, okay, what works, what are the metrics you're looking at, great, but also like a tangible example where, hey, you know what, this did not fit and hence we passed on. I'd love to hear an example of that.
I mean, so I probably, by the time I see a deal, if it's
Mm-hmm.
gotten to investment committee, then our acquisitions team has filtered out some of the easy ones,
Sure.
right? Because I'm not underwriting every deal. Our group right now, it's slowed. Transaction volume slowed a bit, but I would guess that on a daily basis, we're seeing 2 to 4 deals come across the desk, and a
Mm-hmm.
majority of those we're not going to go through a full underwriting process
Sure.
on. So I mean, there are things like location, Sakar, that I sent a 4-property portfolio to our director of acquisitions that's in Brooklyn.
Mm-hmm.
And, he's like, hey, this deal has been circulating for the last 6 months. And we don't want to be in Brooklyn.
I
Okay.
see. Got it.
So, there's these high level things that allow us to filter down. Usually that starts with location. But I would say that many times when we pass on a deal at the investment committee level, it's function of price. And as cap rates have compressed in storage, just like they have in multifamily, right? More capital is starting to chase these deals. The pricing starts to get out of whack. And so for us, we need to deliver the ultimate return to the investor. And if it doesn't meet our underwriting standards, then we ultimately have to pass. And, there's no hard and fast, like we're only going to buy a, 5% going in cap rate, right?
Sure.
It's deal by deal specific. But I would say ultimately, if our investors are expecting kind of that mid-teens return, if we can't get close to that mid-teens cash on cash return, we're most likely going to pass, because that's just essentially what our cost of capital is. And that's really where I think we see the most, we're going to hold the line. We'll put our offer in. If we love the deal, market makes sense, story makes sense, opportunity for maybe a value add makes sense. But if we can't get to the price we need to ultimately have the exit on the back end, then we're going to walk.
I see. Now, Chris, coming to your core expertise of, leading the investment group and, raising lots of equity and things like that, right? Um, what sort of panorama of investors you see, whether it's the retail investors or is that like large insurance, endowment funds or private equity? Give us a sense of what sort of that playbook looks like for you.
Yeah, I would say that we have primarily three buckets of investors. We have kind of our retail high net worth accredited investor, right? Who's, maybe wants to deploy $50,000, $100,000 into the self-storage space. Think doctor, business owner, somebody with a little bit of discretion, some discretionary spend. And
Sure.
they're looking for some diversification away from traditional equities market into a non-correlated asset class like a self-storage. We have some equity groups who have their own retail investors who are looking to get access to a professional manager in the asset class. That's for sure a piece of it. And then I'd say our third bucket is the institutional capital. So we have a really large family office that's been a great partner of ours for many, many years. Great group of people, and a lot of trust between the two groups at this point. We've also done a fairly large portfolio with a private REIT, so what you would consider an institutional investor. And it's interesting, Sakar, every group kind of has their own
nuances of itself, right?
Yeah, and so you just need to understand what you're putting in front of people and what's going to make the most sense for each group. I mean, I think an institutional investor, depending on how they're investing, right? They could be investing off their own balance sheet, like an insurance company, or you could be like a private REIT where you're investing other people's money, and that changes how they view the deal, right? Because an insurance company may not have a horizon, right? They may say, hey, 10 years. Well, that institutional capital shop may say, hey, I need to turn my money every 3 to 5. So it changes, the structures of what you can put in front of them and still have interest. And certainly there's benefits and disadvantages for us as the operator as well, right?
Right.
Large institutional investor, they can write a big check, but they have more control.
Right. And actually, I appreciate the detail you're going into there, Chris, because that's exactly where I was going to follow you as well, where, depending on the size of investor and who's investing and what their motivations are, kind of determines, what your exit is and what sort of levers you have. So please go ahead with your thought, actually.
Yeah, I mean, I think you just have to know what, I guess sales 101, understanding what your customer wants. And we know that by asking questions. And so, generally it's just most people will say, and how we view it kind of on our end with investors is we never want to sell you on what you should do with your money. We'll sell Reliant, like, hey, here's our story. Here's why we think we're, good opportunity for you. But ultimately, you as an investor need to know, here's what my goals are for my money, and I think I can deploy it with you and it makes sense. So that's kind of how we look at it, Sakar.
Right. And I guess another piece of all this also, Chris, is that, educating these folks, right? And it's not like, it's $100-$500 investment, right? I mean, it's a substantial investment for anybody, right? Whether it's discretionary or not, it's a substantial amount of investment. So they have to be convinced and about the asset class as well and understand, what it means and things like that. One thing there, Chris, that you mentioned that you have, the private equity groups coming in and also the life insurance money and stuff like that. What goes into those discussions? Let's say if you're taking the money from private equity, right? And you stated that they would want a exit or sort of roll their funds every 3 to 5 years, right? How does that change the dynamics on your side? Does that mean that you're presenting them different deals because you want to present them more opportunistic, quick value add and quick exit type of deals? I'd be curious to know that.
Yeah, 100%. I mean, I think the deal structure has a unique, I guess, timeline return profile, and you're trying to match that up with the investor you're talking to. And sometimes, Sakar, it's also about your underwriting assumptions. You know, most institutional capital shops are going to be a little more comfortable with some aggressive assumptions, where, you know, if we're presenting something to a retail investor, we don't need to be aggressive.
Right. And sometimes they may not be even aware of a lot of some of the underlying assumptions, but if you're going to a lot more sophisticated or institutional type of investors, as you stated, right, they may probably have done some due diligence on their own side, I would imagine.
Yeah, I mean, look, if you're managing a couple $100 billion, the guys who are running your real estate groups are not dumb people.
Sure, absolutely.
Right? So, you know, they're coming in well educated on the space. Maybe they've invested in already, and they're looking to deploy more capital in the space.
Sure.
Or, you know, potentially it's a new asset class for them, but they've done their homework. And so, you know, many times it's coming up with a comfort level underwriting wise with the group to say, look, you know, here's our assumption. Is that too aggressive? Is it too conservative? How do you need to see it? Because otherwise, Sakar, you're in a much more competitive environment when you're pitching to the institutional capital shops, right? Because they're the hottest girl at school. They have lots of choices for dates, right?
Sure.
And so you don't want to underwrite yourself out of a deal.
Right.
But you also want to find a good partner who has a shared vision. Because if you have an equity partner that you just got married to and you're going to be married to them for, let's call it 3 to 7 years.
Sure.
Boy, if you're not aligned on what you're trying to do, that's an unhappy marriage, you know. And back to my first comment, you got to enjoy the journey, not just the destination.
Sure.
Whether or not you make a lot of money at the end, if you're miserable for 5 years, it's somewhat irrelevant. So I think that's a big part of it too. What we're trying to do, and we're actually in the midst of that right now. We've engaged an investment bank to help us talk with a lot of larger scale investors to understand what that market looks like. And a big part of it is not, they all can write the check, right? And part of it's doing due diligence on us, but a big part of it is understanding, what do you want to do? You know, and here's what we want to do. And does that align? Because if it doesn't, let's not talk anymore. You know, like, let's not set ourselves up to be
Sure. Right. I mean, there are, as we all know, there are multiple, you know, truths to doing lots of things. That doesn't mean that, you know, we are right and someone else is wrong. I mean, there's multiple truths and multiple ways to be, you know, doing business. That's for sure. Now, Kris, you earlier in the show, you stated that your company is vertically integrated and you manage that as well, you know. So I wanted to ask you that, do you think that managing the self-storage units, you know, from front to back, everything, right? Does that give you a competitive advantage in your opinion?
That's a good question. I think in some deals it may. I would say more so on the competitive advantage. Are you saying in the acquisition side or once we own the assets?
Actually, I would say more like end to end, because, you know, I always like to say that from start to manage to exit, right? I mean, there's always a delta, different motivations are involved as to why the management company is getting involved. You know, more so when you have the third party managers, for example, like we all know that they may be in it for repairs and the fees and all the different things they can layer them on, right? So sometimes, you know, having that in-house or the self-management gives you that comparative edge, right? So I'm kind of coming in from that perspective, that so when you are taking all these deals and you know that you have seasoned them for, let's say, 5 to 7 years with your in-house management, you probably have lower cost, I would imagine. So does that maybe give you a, you know, a greater NOI and sort of a good story to sell eventually? So that's why I was wondering that, does that give you, like, an in-house management gives you that advantage basically?
Maybe not so much on the sales side, Sakar, right? Because if we're selling to a REIT, for example, they're going to have their own management platform, right? So they're they don't care what our expense ratios are because they know what their expense to run them are. I think it is an advantage through, you know, the acquisitions and management process, just because you have the ability to deploy strategy quickly.
Sure.
And so if you have something where, if you have something where you're trying to do something in a particular market, whether it's, rental rate growth, or maybe it's a focus particularly on tenant insurance, if it's our management team, we can deploy those strategies quickly. Where if you're relying on a third-party manager, you kind of roll it up to the manager, and the manager tries to deploy it out to their people. It's a much harder process to control. So I think there's definitely some advantages in there. And things like, not everybody likes to do U-Haul because it's kind of a pain. There's some work that goes along with it. But being able to manage your own platform, there's in some of our sites some really strong revenue that comes out of those U-Haul rentals, and generally is bringing people who have a need for storage to the site, right? If I'm going to rent a U-Haul truck, there's pretty good bet that, you may need some storage
help with
square footage as well. So those kinds of things, I think, make the operations platform valuable for us.
Interesting. Now, in your role, Kris, with you being the chief investment officer, you are always on the hunt for money sorts, right? I mean, you're always on the hunt for new sources of capital and things like that. So, how are you acquiring this? And I'm especially curious to know that the retail investors acquisition for them is one thing, but trying to go to, let's say, the larger private equity players, or perhaps the other mutual fund or life insurance companies and university endowments and things like that, right? I mean, that's a leg up in terms of going out to and acquiring it. What does that look like on your end? Like, what sort of strategies you're doing? Is that like the conferences or the different meetups, or is that the cruise or the clubs? What different activities you're doing to kind of get into that space?
So specific to the larger institutional investors, I would say that the best success we've had is engaging groups who they're used to seeing deals come from. Specifically, and I think you got to categorize that a little bit as well. Like, family office money is very relationship driven, right? So, they want to have a relationship with the groups that they're raising capital or deploying capital with. Institutional shops are just trying to deploy capital at scale. And some of the university endowments, we met with Harvard and Yale's university endowments last summer, and that came from cold calling. Literally, going on the website, starting to email everybody, reaching out with phone calls, and see if they'd be willing to sit down with us. And they did. But think about like a Harvard endowment. They manage $38 billion in their endowment, plus or minus a few billion. And they have a very small team. So their biggest issue is they can't invest in too many opportunities because there's not that much to support it, right? They don't have a couple hundred people in their office. They may have 20. And that's a lot of money to manage with 20 people. So, for us, the issue, for example, Harvard said no. One of the issues was they like to deploy 1% of their fund with each manager. So on a $38 billion fund, that's $380 million of equity. They looked at us and not necessarily sure we could deploy $380 million of equity. And I looked at us and said, that's quite a stretch at the investment terms that you're looking for. So,
absolutely.
There's definitely a balance as you start to talk to larger investors. They have to deploy capital at scale to make it worth their while to do the due diligence work up front. So they may say to you, look, we're not going to talk to you unless you can put $50 million to work. Even if I came to them today and said, hey, give me 10 million tomorrow, I'll give you 20. They would say, that's not worth it. Like, it doesn't even move the needle. So
why?
you have to kind of understand the perspective that they're coming from as well. And where we've had the most success with the larger institutional investors is really the investment banking world, and being able to engage a shop like that to go out to people who say, look, we've done our due diligence on this group. We'll bring you access to deals. And they're used, that's, the big shops in New York, the Blackstones, KKRs, Apollo, well, these big private equity real estate funds, that's how most of the time they're seeing deals. They're being brought stuff that says, hey, this fits, we've done a deal with you in the past, this fits. And then you're paying, the investment bank a percentage of whatever equity gets deployed from those groups.
Sure, sure. And boy, I mean, I just appreciate your insights. This has been such a great conversation, Kris. I absolutely appreciate the amount of knowledge you're sharing here. One couple of quick questions, Kris, before we run out of time here. That relationship with the bigger players, the institutional players that you said, what sort of time horizon it needs, for the relationship to cultivate? Is that like 2 months, 3 months, 6 months? What does that look like?
You're saying from the time they meet you to the time they deploy capital?
Sure, sure. Mm-hmm.
I think it probably depends. They're going to go through a due diligence process with you, first understanding, what your pipeline looks like. And again, that you have the scale to deploy enough capital for them to make it worthwhile, right? Like the worst thing that they could do is approve you as a manager. Let's say, you go through due diligence process, they say, yep, I want to work with you, Sakar, and you deploy $10 million and nothing else. And they've just wasted, again, it doesn't move the needle for them, right? Right. Even if you crush it with that $10 million, they're going to look at you and say, hey, we needed to do 75 or 100. So, I think that's part of it is they're going to go through that due diligence process with you. There's one group we've been talking to, for a year, and we're almost at the point where we can see a term sheet, where they're going to provide a term sheet to us to say, here's what we think. But there's some really interesting synergies between the groups and what they want to do and what we want to do, which is why we've continued to, foster that relationship. So I think it depends, on the group. The one thing I would say, for your listeners too, is the track record's a big part of this, right? So
absolutely.
Again, they're the prettiest girl at school, so they can date anybody they want, and you gotta have a something that stands out to them, for them to be interested, for sure.
I know. I mean, it's amazing with your sales background. I think patience and knowing that you could be too close, but still too far at times, and that can go on for quite some time. So, boy, I appreciate your time, Kris. Please tell our listeners, Kris, what sort of is your best advice into all of this?
Are we talking about life, Sakar, or is this just
whether it's life or investments, or some of the best advice you may have heard, and that keeps you in discipline every day?
Yeah, I mean, I would say that I guess my life advice is jump, be opportunistic. When you see and feel an opportunity in front of you, don't be afraid to go pursue it. I have an 18-year-old son who is in the midst of career, life decisions, big boy decisions. And what I said is, buddy, I still don't know what I want to do when I grow up. Go into every opportunity, do it the best you can, and be opportunistic while you're there, right? And if you find something that you're like, ooh, that's really neat, don't be afraid to make that jump. And it's scary, right? But there's a reason you think, ooh, that's really interesting. And maybe it flops, and it certainly could. But I think when you look back at your time on the earth, if you're going to be much more satisfied saying, hey, I tried, versus, I stayed with what was safe and, regret it. And for me, that's my kind of life thing, is I just don't want to look back and be like, man, I should try that, and it's worked out for us pretty well so far. I mean, not to say I haven't made mistakes. That is 100% not true. But I've certainly learned a lot. And I think if you're uncomfortable consistently, that means you're learning.
Wonderful. Go-getter advice. Don't be regretful as your life goes. I love that aspect. Please share with our listeners, Kris, how they can find you and learn more about your company and everything.
Sure. The investment side of things, if you're interested in the platform, you can go to ReliantInvestments.com. And we have a bunch of information on there, our current offerings. There's some educational commentary. There's some free videos, that kind of stuff on the website. I'm on LinkedIn, pretty active. It's Kris Benson with a K. We put a bunch of stuff out there as well. I think that's probably a good start.
Awesome. It's been wonderful, Kris. Thank you. I have always been looking forward to this show. And oh boy, you delivered some punch and you delivered some great insights. So I appreciate your time today. I will, look forward to, exchanging further notes with you and having you on a future podcast as well. So thank you for coming on today. It's been a pleasure.
My pleasure, Scar. Hope you have a good rest of the day.
Thank you.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.